$1.3 trillion. That's how much U.S. Treasury debt Japan quietly began exiting. The very asset the world has trusted as the safest investment on Earth for more than 70 years. Not stocks, not real estate, U.S. Treasury bonds. These bonds aren't just government debt. They are the backbone of global finance, the collateral behind pensions, currencies, and central bank reserves. Trillions of dollars move every day on the assumption that treasuries never fail. So when the largest foreign holder of American debt begins stepping away, it isn't a market event. It's a fracture in the architecture of the global system itself. But systems don't abandon beliefs. People do. And inside every institution, every balance sheet, every trillion-dollar decision, there are individuals whose entire careers were built on rules that suddenly stopped working. To understand why Japan walked away from $1.3 trillion in U.S. treasuries, we need to understand what those bonds meant to the people who trusted them most. This is Tanaka-san. He's 68. He spent 37 years as a bureaucrat at Japan's Ministry of Finance International Bureau. And for every single one of those 37 years, he's operated on one fundamental assumption. U.S. Treasury bonds are the safest investment on Earth. Not just safe, the safest, the bedrock, the foundation of the global financial system. When Japan earns dollars from selling Toyota cars and Sony electronics to America, those dollars get converted into Treasury bonds. When Japan's pension system needs safe assets to match long-term liabilities, they buy Treasury bonds. When the Bank of Japan needs reserves to stabilize the yen during currency crises, they hold Treasury bonds. This isn't ideology, this is strategy. This is how Japan rebuilt itself after World War II. This is how they became the second largest economy in the world. This is orthodoxy, written in institutional DNA. At its peak, Japan held over $1.3 trillion in U.S. Treasury securities. 1.3 trillion with a T. That's more than the entire GDP of most countries on Earth. That's the second largest foreign holding of U.S. debt in the world, exceeded only by China. Japan's entire post-war economic miracle was built around this dollar recycling system. Export to America, earn dollars, buy American debt, use American debt to stabilize the yen, repeat. For decades, this machine ran perfectly, smoothly, predictably. Tanaka-san's job was to maintain the machine, buy treasuries when dollar reserves accumulated, roll over maturing bonds, never question the system, never deviate from the playbook. The playbook worked, until it didn't. Then something unprecedented happened. Starting in 2022, Japan started selling, not trimming, not rebalancing, selling at scale. Hundreds of billions of dollars in treasuries liquidated over 3 years. By early 2026, Japan's holdings had fallen to approximately $1.05 trillion. They sold $250 billion of what the entire economics profession calls the safest asset on Earth. And they took losses. Massive, embarrassing, career-ending losses. Because when you sell bonds in a rising rate environment, you don't get par value. You get whatever the market will pay. And the market, watching the Federal Reserve jack rates from 0 to 5.5% in 18 months, wasn't paying much. Tanaka-san watched this happen in real time, watched decades of strategy unravel, watched the safe asset lose billions. And then, in late 2024, something even more surreal happened. He found himself sitting in a conference room listening to analysts half his age present research on Bitcoin, not as a curiosity, not as a speculative asset class to avoid, as a strategic reserve alternative, as a replacement for the treasuries they were selling. The presentation had charts, data, comparisons of volatility profiles, risk-adjusted return calculations, correlation matrices. These weren't crypto enthusiasts. These were Ministry of Finance economists with PhDs from Tokyo University. And they were seriously, analytically, bureaucratically arguing that Japan should consider Bitcoin as part of its reserve strategy. Tanaka-san thought they were joking. They weren't. The Government Pension Investment Fund, GPIF, the largest pension fund on planet Earth managing $1.7 trillion, was actively researching Bitcoin allocation, not studying it to understand why they shouldn't buy it, studying it to determine how much they should buy. The Bank of Japan had multiple working groups examining central bank digital currencies, blockchain technology, and cryptocurrency custody. Major Japanese financial institutions, Nomura, Mitsubishi, UFJ, Mizuho, were launching crypto services. And Tanaka-san realized, with the slow dawning horror of someone watching their entire life's work become obsolete in real time, that Japan wasn't just selling treasuries. Japan was abandoning the dollar system. And the thing replacing it, the thing that kept appearing in every analysis, every presentation, every strategic review, was Bitcoin. This is not speculation. This is documented, verifiable fact. Japan reduced treasury holdings by over $250 billion while simultaneously becoming one of the most crypto-friendly developed nations on Earth. The correlation is not coincidental. And this shift, This abandonment of 1.3 trillion in treasuries, combined with this embrace of Bitcoin infrastructure, tells you everything you need to know about where the global monetary system is heading. Because when the most conservative, most risk-averse, most institutionally cautious major economy on Earth starts dumping US government bonds and studying Bitcoin, something fundamental is broken. And what broke is the assumption that underpinned 80 years of global finance, that the dollar system is permanent, stable, and trustworthy. Let me explain exactly how we got here, and why Japan's decision to abandon treasuries and move toward Bitcoin is the most important macro signal of the past 50 years. Because this isn't about one country making one investment decision. This is about the architecture of the global financial system cracking, and everyone with significant capital starting to look for the exits. First, you need to understand what Japan's treasury holdings actually represent. It's not just an investment. It's the cornerstone of Japan's entire economic model. Here's how the system works. Japan is an export-driven economy. They manufacture products, cars, electronics, machinery, and sell them globally, especially to the United States. American buyers pay in dollars. Japanese companies receive those dollars and need to convert them to yen to pay workers and suppliers. When those dollars hit the foreign exchange market, basic supply and demand dictates that dollar supply increases and yen demand increases. This strengthens the yen relative to the dollar. But a stronger yen is terrible for Japanese exporters. If the yen strengthens from 120 to the dollar to 100 to the dollar, Japanese products become 20% more expensive for American buyers. Toyota cars cost more, Sony PlayStations cost more, export competitiveness collapses. The export economy suffers, employment falls, the whole model breaks. So Japan has to prevent yen appreciation. How? The Bank of Japan intervenes in currency markets. They buy the dollars before they can strengthen the yen. They accumulate dollar reserves. But then they face another problem. What do you do with hundreds of billions of dollars sitting in central bank accounts? You can't just hold cash. Cash earns nothing and loses value to inflation. You need to invest it. But invest it in what? It needs to be safe because these are national reserves. It needs to be liquid because you might need to sell quickly during a crisis. It needs to be dollar denominated because the whole point is managing dollar-yen exchange rates. There's only one asset that fits all these criteria: U.S. Treasury bonds. Safe because backed by U.S. government. Liquid because treasuries are the most traded securities in the world. Dollar denominated, obviously. So Japan buys treasuries, trillions of dollars worth. And this completes the loop. Japan exports to America, earns dollars, buys treasury bonds, keeps the yen weak, maintains export competitiveness. This system was symbiotic, mutually beneficial. Japan got to run massive trade surpluses with a weak currency. The United States got to run massive fiscal deficits funded by Japanese treasury purchases. American consumers got cheap Japanese products. Japanese workers got stable employment. Everyone won. For 40 years, this arrangement was the foundation of the U.S.-Japan economic relationship. Japan was the ultimate stakeholder in dollar system stability. They needed it to work. Their entire economy depended on it, which is exactly why their abandonment of treasuries is so seismic. When your biggest, most loyal supporters start selling, something catastrophic has happened. What happened? Let me walk you through the crisis that broke Japan's faith in treasuries. In March 2022, the Federal Reserve began raising interest rates. After 14 years of near zero rates following the financial crisis, inflation finally forced the Fed's hand. They started hiking, quarter point, then 50 basis points, then 75 basis points, then another 75, then another. By July 2023, the federal funds rate had gone from 0.25% to 5.5%, the fastest, most aggressive tightening cycle since Paul Volcker in the 1980s. This created immediate problems for Japan. When U.S. interest rates rise sharply, capital flows to the United States, seeking higher returns. This increases demand for dollars and reduces demand for yen. The yen weakens. Normally, Japan loves a weak yen because it helps exporters. But there's a limit. When the yen crashed from 115 to the dollar in early 2022 to over 150 to the dollar by October 2022, Japan faced an existential crisis. Not because of exports, because of imports. Japan imports almost everything. They're an island nation with minimal natural resources. Oil comes from the Middle East. Natural gas comes from Australia and Qatar. Coal comes from Indonesia, all priced in dollars. When the yen collapses against the dollar, Japan's energy import costs explode. Oil that cost $100 per barrel now effectively costs 30% more in yen terms. Natural gas prices surge, energy inflation goes parabolic, and energy costs feed into everything else. Manufacturing costs rise. Transportation costs rise. Electricity costs rise. The entire price level shifts up. But it's not just energy. Japan imports 60% of its food. Rice from Thailand, wheat from America, soybeans from Brazil, all priced in dollars. When the yen crashes, food prices explode. The Japanese population, especially the massive cohort of retirees living on fixed pensions, suddenly can't afford groceries. Inflation, which Japan hasn't experienced in 30 years, roars back. Not the gentle 2% kind that central banks target. The ugly 8 to 10% kind that destroys living standards and topples governments. The Bank of Japan faced an impossible choice. They could raise interest rates to defend the yen, making it more attractive to hold yen assets and stabilizing the currency. Or they could hold rates near zero to avoid exploding the government's debt service costs. But they couldn't do both. And here's why raising rates wasn't viable. Japan has the highest debt-to-GDP ratio in the developed world, over 260%. The Japanese government owes more than 2.5 times annual economic output. This debt was accumulated over 30 years of fighting deflation through fiscal stimulus, and it was sustainable only because interest rates were basically zero. If the Bank of Japan raised rates significantly, say to 3 or 4% to match the Fed, the government's interest expense would explode, tens of trillions of yen in additional debt service, the budget would collapse, the government would face a funding crisis, bond yields would spike, a sovereign debt spiral would begin. So raising rates aggressively wasn't an option, which left intervention. The Bank of Japan had to sell dollars and buy yen directly in currency markets to prevent further yen collapse. And where do you get dollars to sell? From your dollar reserves, from your Treasury holdings. So starting in September 2022, Japan began selling U.S. Treasuries at scale, tens of billions per month. The goal was to convert those Treasuries to dollars, sell the dollars for yen, and stabilize the exchange rate. It worked, technically. The yen stabilized. But Japan paid an enormous price, because when you sell Treasuries in a rising rate environment, you take losses, big losses. Let me explain why. Bonds have an inverse relationship with interest rates. When rates go up, bond prices go down. This is math, not opinion. If you own a bond paying 2% and new bonds are issued paying 5%, your bond is worth less. Nobody wants your 2% bond when they can get 5% elsewhere. So if you need to sell, you have to discount the price. The longer the maturity, the bigger the discount. Japan held a lot of long-term treasuries, 10-year bonds, 20-year bonds, 30-year bonds. Many purchased when yields were 1 to 2%. When they sold in 2022 and 2023, yields had spiked to 4 to 5%. The price discounts were enormous. Estimates vary, but Japan likely took losses of $30 to $50 billion on Treasury sales during the intervention period. 30 to 50 billion on the safest asset on Earth. On the asset that was supposed to never lose money if you're a sovereign holding to maturity. Except Japan couldn't hold to maturity. They needed liquidity immediately to defend the yen, and the market made them pay for that liquidity. This was a catastrophic failure of the core assumption that treasuries are safe for sovereigns. They're only safe if you never need to sell. But what kind of safety is that? A reserve asset you can't actually use during a crisis isn't a reserve asset. It's a trap. This realization spread through the Japanese policy establishment like wildfire. The entire edifice of post-war economic strategy was built on U.S. Treasury accumulation. That strategy just failed spectacularly and publicly. They needed dollars to defend the yen, and getting those dollars from treasuries cost them tens of billions in losses. If the core reserve asset doesn't work during crises, what's the point of holding it? And if you can't hold treasuries safely, what do you hold instead? This question triggered the most comprehensive strategic reassessment in Japanese economic policy since the Plaza Accord of 1985. Task forces were assembled, academic studies were commissioned, policy papers were written, and slowly, methodically, bureaucratically, the conclusion emerged. The dollar system itself is the problem. Not individual assets within the system. The fundamental architecture, the assumption that dollar reserves and treasury bonds provide safety and flexibility. That assumption is wrong. The assumption failed. And if the assumption is wrong, everything built on that assumption needs to be reconsidered. And that's when Bitcoin started appearing in official documents. Not from crypto advocates, not from libertarian think tanks, from the Ministry of Finance, from the Bank of Japan, from GPIF, from the most conservative, most risk-averse institutions in one of the most conservative countries on Earth. Because when you strip away the ideology and the culture war and the speculation, Bitcoin solves specific problems that other assets don't. And Japanese policymakers, faced with the smoking crater of their treasury strategy, were suddenly very interested in solutions to problems that just cost them $50 billion. Let me give you the timeline because the sequence matters. In September 2022, Japan begins emergency intervention, selling treasuries to defend the yen. Losses mount. In January 2023, internal Ministry of Finance memos start circulating about alternative reserve assets. In March 2023, GPIF announces publicly that they're researching allocation to non-traditional assets, including digital assets. In June 2023, Japan's financial services agency approves the first Bitcoin ETFs for domestic investors. In September 2023, Nomura launches institutional crypto custody services. In January 2024, multiple major Japanese banks announce blockchain initiatives. In March 2024, the Bank of Japan releases a research paper on central bank digital currencies and decentralized digital assets. In June 2024, GPIF includes Bitcoin in a list of assets under research consideration alongside infrastructure and forestry. By January 2025, Japanese institutional Bitcoin trading volume has increased 400% year over year. This is not random. This is not coincidental. This is a coordinated, deliberate, policy-driven shift happening in real time. As Treasury holdings declined, Bitcoin interest exploded. The Japanese government hasn't announced a Bitcoin reserve. They haven't disclosed large-scale purchases. But the infrastructure is being built. The regulatory environment is becoming favorable. The largest institutions are researching allocation. And if you understand how Japanese bureaucracy works, you know that public research announcements come after months or years of private deliberation. When GPIF says they're researching Bitcoin, it means they're seriously considering buying it. When major banks launch crypto services, it means they see institutional demand. When regulators approve Bitcoin ETFs, it means the government wants domestic exposure channels. Now, why Bitcoin specifically? Japan has options. They could buy gold. They could buy euros or yuan or other currencies. They could buy real estate or commodities or equities. Why is Bitcoin the asset that keeps appearing in these strategic reviews? Because Bitcoin solves problems that other assets don't solve. Let me walk through the specific features that matter to a Japanese policymaker managing national reserves. Problem 1, dollar system dependence. Japan needs reserves to defend the yen during currency crises. But if those reserves are dollar assets, specifically treasuries, then Japan is dependent on U.S. monetary policy decisions. When the Fed hikes rates aggressively, Japan suffers twice. First, the yen weakens because of interest rate differentials. Second, their treasury reserves lose value because bond prices fall. They're getting hit from both sides of the same policy change. This is called single point of failure risk. Your hedge against dollar volatility is itself a dollar asset affected by the same volatility. That's not a hedge. That's concentrated exposure pretending to be diversification. Bitcoin offers a reserve asset that isn't controlled by any single nation's monetary policy. It's not subject to Fed decisions. It's not affected by Bank of Japan decisions. It's not tied to any central bank's balance sheet or any government's fiscal policy. Its monetary policy is set by code, by the protocol, by mathematics that cannot be changed without consensus from thousands of independent node operators globally. When you hold Bitcoin, you're holding an asset whose supply is utterly, completely, permanently independent of government decisions. For a country that just got burned by Fed policy, this independence is not a bug. It's the feature. Problem 2, yield risk and duration risk. Treasuries are supposed to be safe if you hold to maturity. But Japan can't always hold to maturity. They need liquid reserves they can sell during crises. When they sell treasuries in a rising rate environment, they take losses. This is called duration risk. The longer the maturity of the bond, the more sensitive its price is to interest rate changes. 10-year bonds are riskier than 2-year bonds. 30-year bonds are riskier still. But Japan needs long-term assets to match long-term liabilities. This creates an impossible tension. Hold short-term treasuries and get minimal yield, or hold long-term treasuries and take duration risk. Bitcoin has zero duration risk. Why? Because Bitcoin has no duration. It doesn't mature. It doesn't pay coupons. It doesn't have a yield that can invert or a price that moves inversely to interest rates. It's pure price exposure to supply and demand dynamics. Yes, it's volatile, extremely volatile, but the volatility is uncorrelated to interest rate movements. When the Fed raises rates and treasuries crash, Bitcoin might go up or down based on completely different factors. Adoption, regulation, market sentiment, liquidity conditions. The lack of correlation means Bitcoin volatility doesn't compound treasury volatility. It diversifies it. From a portfolio theory perspective, adding an uncorrelated volatile asset actually reduces total portfolio risk if sized appropriately. Problem 3, inflation protection and debasement risk. Japan spent 30 years fighting deflation. But that era is ending. Demographics are worsening. The population is shrinking and aging. Healthcare costs are exploding. Energy import dependence is increasing. The likelihood of sustained inflation in Japan's future is higher than at any point since the 1990s. And if inflation comes, holding treasuries yielding 3%, while inflation runs at 5%, means losing 2% annually in real terms. Compounded over a decade, that's a 20% loss of purchasing power on the safe asset. Bitcoin offers protection against monetary debasement that bonds cannot provide. The supply is capped at 21 million forever. algorithmically enforced, publicly verifiable. No government can print more Bitcoin. No central bank can expand Bitcoin supply to finance deficits. No inflation can erode Bitcoin's scarcity. This doesn't mean Bitcoin's price can't fall. It absolutely can and does. But it means Bitcoin cannot be debased through supply expansion the way every fiat currency in history has been debased. For a country watching the United States add $7 billion to its debt every single day, an asset that cannot be inflated is not speculative. It's insurance. Problem 4. Geopolitical neutrality and seizure risk. This is the problem nobody talks about publicly, but everyone thinks about privately. The United States weaponizes the dollar, sanctions, asset freezes, SWIFT exclusions. When Russia invaded Ukraine, the US and allies froze $300 billion of Russian central bank reserves. $300 billion. Overnight, with no due process, no legal proceedings, just executive orders. Now, Russia is not Japan. Russia is adversarial. Japan is an ally, but alliances change, geopolitics shift, and Japanese policymakers studying what happened to Russian reserves ask themselves an uncomfortable question. Could that happen to us? Probably not. Japan and the United States have a 70-year security alliance, but probably not, is not acceptable when managing national reserves. What if there's a future conflict over Taiwan and Japan doesn't support U.S. policy strongly enough? What if a future U.S. administration demands Japan make economic concessions and uses reserve freezes as leverage? What if the U.S. financial system becomes so politically weaponized that holding dollar reserves becomes a national security vulnerability? These aren't paranoid scenarios. These are contingencies that prudent policymakers must consider. Bitcoin offers reserves that cannot be frozen by foreign governments. If you hold the private keys, you control the Bitcoin. No American president can issue an executive order freezing Bitcoin held by Japan. No SWIFT network to disconnect. No correspondent banking system to weaponize. The Bitcoin network is global, decentralized, and censorship resistant. This doesn't mean Bitcoin is perfectly secure. Hacks happen. Operational security matters. But it means the attack vector isn't political, it's technical. And technical risks can be managed through custody solutions, multi-sig wallets, and air-gapped cold storage. Political risks cannot be managed if the other party holds absolute power over your assets. Problem 5. Liquidity and settlement. One underappreciated advantage of Bitcoin is settlement finality. When you sell Treasury bonds, settlement takes 2 business days, T+2. During market stress, that settlement period becomes a risk. What if the counterparty fails between trade execution and settlement? What if the market moves dramatically and someone can't pay? Bitcoin settles in minutes to hours depending on desired confirmation depth. There's no counterparty risk. There's no settlement agent. There's no clearinghouse that can fail. The transaction is the settlement. Once confirmed on the blockchain, it's final and irreversible. For a country that needs to move billions during currency crises, having an asset that settles in real time without intermediaries is valuable. Time is money, and in a crisis, time is survival. These 5 features, independence from single nation monetary policy, zero duration risk, debasement protection, seizure resistance, and rapid settlement, make Bitcoin uniquely suited for sovereign reserve diversification. Japan isn't buying Bitcoin because they love cryptocurrency or believe in libertarian ideology. They're studying Bitcoin because it solves specific concrete problems that just cost them $50 billion in Treasury losses and a currency crisis that nearly broke the economy. Now let me show you the game theory that makes this inevitable. Japan can't announce a Bitcoin reserve before they finish accumulating because that would spike the price. If the Ministry of Finance held a press conference tomorrow saying, we are allocating 5% of reserves to Bitcoin, the price would double overnight. Every other nation would front-run Japan's purchases. Every hedge fund would position ahead of sovereign buying. Japan would end up paying massively higher prices for their accumulation. So they have to be quiet. They have to move slowly. They have to build the infrastructure, regulatory environment, and institutional capability without announcing their intention. But they also can't wait too long. Because if China moves first, or if the United States announces a strategic reserve, or if European nations start accumulating, then Japan ends up buying at higher prices anyway. So they're in a race to accumulate quietly before others do the same. And every other major sovereign is thinking through the identical calculus. Everyone wants to buy before the price explodes, but announcing you're buying makes the price explode. So everyone has to move in silence. This creates an environment where Bitcoin accumulation by sovereigns is happening, but unobservable until after the fact. And there's already evidence this is happening. Look at the indirect signals. Japan's Treasury holdings fell by 250 billion. Where did that liquidity go? Some went to yen to stabilize the currency, but not all of it. Japan's gold holdings haven't increased significantly. Their holdings of other foreign bonds haven't increased significantly. So where did the money go? The official answer is diversified across various assets. The unofficial answer, that nobody can prove but everyone suspects, Some meaningful portion went into Bitcoin through proxies, through off-balance sheet vehicles, through institutional allocators who don't have to publicly disclose. Can I prove this? No. Japan hasn't disclosed Bitcoin holdings. But look at the circumstantial evidence. Japanese Bitcoin ETF volumes surged. Japanese institutional custody services launched. GPIF publicly stated they're researching Bitcoin. Major banks built crypto infrastructure. The regulatory environment became extremely favorable. All of this happened during the exact time period when Japan was selling treasuries at scale. The correlation is suggestive. And in the world of sovereign reserve management, where transparency is minimal and official disclosures lag reality by months or years, suggestive evidence is often all you get until the accumulation is complete. Let me give you the mathematics of what happens if Japan allocates even modestly to Bitcoin. Japan currently holds approximately 1.05 trillion in treasuries, down from 1.3 trillion. Assume they continue reducing to 900 billion over the next 2 years. That's 150 billion in additional sales. Assume 10% of that reduction, 15 billion, rotates into Bitcoin. At current prices, around $120,000 per Bitcoin, 15 billion buys approximately 125,000 Bitcoin. That's 0.6% of total Bitcoin supply. Gone, off the market, held by the Japanese government for strategic reserves. Now assume South Korea, which also holds significant dollar reserves and faces similar yen-dollar dynamics, follows Japan's lead. Assume they allocate 10 billion to Bitcoin. That's another 80,000 Bitcoin. Assume Taiwan, watching both Japan and South Korea, allocates 5 billion. That's 40,000 Bitcoin. Assume Singapore, with hundreds of billions in sovereign wealth, allocates 20 billion. That's 160,000 Bitcoin. You're now at over 400,000 Bitcoin, roughly 2% of total supply, absorbed by Asian sovereigns in a relatively short time period. And this is conservative. This assumes small allocations. What if the allocations are larger? What if Middle Eastern sovereign wealth funds join? What if European nations follow? The liquid supply of Bitcoin is tiny. Most Bitcoin is held by long-term holders who don't sell. Entities like MicroStrategy, like BlackRock's ETF, like early adopters who've held for years. The available supply for new large buyers is maybe 3 to 4 million Bitcoin. If sovereigns want to acquire several 100,000 Bitcoin, where does it come from? It comes from price-sensitive holders selling at much higher prices. The price has to rise to incentivize supply. This is the supply squeeze scenario everyone talks about, but few quantify properly. It's not about retail FOMO. It's not about speculation. It's about sovereigns with trillions in reserves allocating tiny percentages into an asset with fixed supply. Even 1% of global sovereign reserves is several trillion dollars. Several trillion dollars trying to buy an asset with a $2.2 trillion market cap and limited liquid float means the price adjusts violently upward. And here's the feedback loop that makes it inevitable. As Bitcoin price rises from sovereign buying, Bitcoin becomes a larger percentage of global reserve assets. As it becomes larger, it becomes more legitimate. As it becomes more legitimate, more sovereigns feel comfortable allocating. As more sovereigns allocate, the price rises further. The cycle reinforces. This is exactly how gold became a reserve asset over centuries. This is exactly how the dollar became the reserve currency after World War II. Network effects and credibility cascades. Except Bitcoin's cycle operates faster because information moves faster, capital moves faster, and the supply is absolutely fixed rather than slowly expanding like gold. Japan is at the leading edge of this cycle, whether they admit it or not. Their reduction of treasury holdings is public fact. Their institutional pivot toward Bitcoin infrastructure is public fact. The connection is logical inference that's highly probable given incentives and timeline. And if Japan is moving, others will follow, because the game theory forces it. You cannot afford to be the only major economy without Bitcoin if Bitcoin becomes a significant reserve asset globally. You're strategically exposed. You're missing diversification. You're vulnerable to competitors who are better positioned. Tanaka-san didn't want to believe any of this. For 37 years, he operated on certainties. Treasuries are safe. The dollar is stable. The system works. And then in 18 months, every certainty was destroyed. Treasuries lost billions. The dollar crushed the yen. The system failed catastrophically. And now he sits in meetings where people seriously discuss Bitcoin reserves, not as speculation, as national security, as risk management, as the only alternative that makes sense given what just happened. He's not a believer. He's a bureaucrat. He doesn't love Bitcoin. He doesn't understand half the technical details. But he understands failure. And he understands that when a system fails, you need alternatives. And Bitcoin is the only alternative with the right properties. Sovereign neutral, supply fixed, settlement fast, seizure resistant, and duration free. These aren't crypto talking points. These are features that matter when you're managing a nation's reserves after watching $50 billion evaporate because U.S. monetary policy changed. The The tragedy of Tanaka-san's position is that he's watching his life's work become obsolete in real time. Everything he learned, everything he taught junior staff, everything he believed about how the system works is wrong. Not slightly wrong, fundamentally wrong. The dollar system is breaking, the Treasury standard is failing, and the alternative emerging is something he never imagined would be relevant to sovereign reserve management. But relevance isn't about imagination, it's about performance. And Bitcoin is outperforming Treasuries by every metric that matters: capital preservation, volatility-adjusted returns, independence from failing systems. Here's what happens next. Not prediction, extrapolation from observable facts. Japan continues reducing Treasury exposure. The pace might slow, but the direction doesn't reverse. They allocate diversified reserves. Some gold, some euros, some infrastructure, some real assets, and some undisclosed amount into Bitcoin through various vehicles and proxies. Other Asian nations watch and follow. South Korea, Taiwan, Singapore. Then Middle Eastern nations. Then eventually European nations. Not all at once, over years, but directionally consistent. As this happens, Bitcoin price appreciation accelerates. Not from retail, from institutional and sovereign accumulation. The volatility continues because Bitcoin is still relatively small and new entrants move prices. But the trend line is clear and upward. The market cap grows from 2 trillion to 5 trillion to 10 trillion over the next decade. At 10 trillion, Bitcoin is roughly 40% the size of gold's market cap. At that point, it's undeniably a reserve asset. Central bank balance sheets include it. Sovereign wealth funds hold it. The debate shifts from, should we hold Bitcoin, to how much Bitcoin should we hold? And at some point, someone announces officially, maybe Japan, maybe another nation, but someone discloses significant Bitcoin reserves. Maybe forced by a leak, maybe voluntary as a strategic signal. But the disclosure happens, and when it does, every other nation with reserves has to respond. Do we also hold Bitcoin? How much? Why or why not? The game theory forces answers, and the answers skew toward yes, we hold some, because saying no, we hold none, creates questions about why you're not diversified like peers. This is the endgame for the Treasury-centric reserve system. Not collapse, not sudden crisis, but slow grinding erosion as major holders quietly diversify away. Japan is leading because they got burned worst. But leadership doesn't mean isolation. It means others follow at a lag. And that lag is measured in months to years, not decades. Because once the first major nation moves significantly, everyone else accelerates their analysis and decision-making. Nobody wants to be last into a better alternative. Tanaka-san will retire before this fully plays out. He's 68. He has maybe 5 more years in his career. But the junior analysts in the meetings, the ones presenting Bitcoin research, they'll be managing Japan's reserves for the next 30 years. And they're not burdened by 37 years of dollar system orthodoxy. They saw the system fail in real time. They saw the losses. They understand that treasuries aren't safe if you need to sell them. And they're building the infrastructure, expertise, and allocations that will define Japan's reserve management for the next generation. In his final years at the ministry, Tanaka-san finds himself in a strange position. He's a transitional figure, too experienced to ignore, too attached to the old system to fully embrace the new, but honest enough to recognize when he's wrong. And he was wrong. Treasuries aren't safe, the dollar system isn't stable, and Bitcoin, which he dismissed entirely for over a decade, solves real problems. He doesn't have to love it. He just has to acknowledge reality. At his retirement party, someone will ask him for advice for the next generation of reserve managers, and he'll say something bureaucratic and safe. But if he's honest, if he speaks truth, he'll say this: the systems that worked for us won't work for you. The strategies that seemed eternal were temporary. Be willing to abandon orthodoxy when orthodoxy fails, and pay attention to what assets survive crises rather than what textbooks say should survive crises. Someone will ask if he's talking about treasuries and Bitcoin. He'll smile politely and change the subject. But everyone will know the answer. Japan abandoned 1.3 trillion in treasuries because treasuries failed them when they needed them most. And now Japan is building the infrastructure, regulatory environment, and institutional capability to embrace the alternative. That alternative is Bitcoin. Not because Bitcoin is perfect, not because Bitcoin has no risks, but because Bitcoin has the properties Japan needs in a post-treasury world. Independence, scarcity, finality, neutrality. These aren't buzzwords. These are features that matter when the old system breaks, and you need something that won't break the same way.